Hi, everyone. This is Tony D'Amico with Fidato Wealth. Thank you very much for joining us today for this video. I wanted to put together a video. There's been a lot of talk lately in the news about the potential for a recession this coming year. There's a lot of noise about this, a lot going on in the news. So I reviewed some research that I thought was really fascinating, and I'm going to review this research with you and share with you, I guess, my take on the research and my interpretation of this. I think you'll find this very helpful. All right, so I'm going to share my screen with you next. So the title of this presentation is called, Are We Headed for a Recession, Soft Landing, or Continued Growth? We're going to take a look at what is a recession and what causes them, how long does a recession last, and what happens to the markets in a recession. We'll also discuss how close we are to the next recession and what economic indicators coincide with a recession. We'll talk about current economic conditions. We'll also discuss what we've done to protect against that market volatility that comes with a recession. And we'll also discuss what you need to do to maximize your financial success. So before we get started, you can see our disclosure is on the screen. Two things that I want to point out. One is if you're watching this video and you're not a client of our firm, we obviously don't know anything about you, such as your goals or financial circumstances or your risk tolerance or really anything about you. So you should view this as strictly for educational purposes, and you shouldn't make any investment or financial planning decisions based upon this information. Also, if you're an existing client and you're watching this video and you have questions about your financial plan or wondering if you should make any adjustments or anything like that, please reach out to us first, and we can talk about that in the context of your goals and your specific financial circumstances and financial plan. All right. So again, we're going to discuss, are we headed for a soft landing, perhaps continued growth or muted growth? Or is there maybe a hard landing for the economy on the horizon? So let's first define what is a recession and what causes them. So recessions are commonly defined as at least two consecutive quarters of declining GDP or gross domestic product after there's been a period of growth. So, and what a recession is that's an economic definition or a term that describes the economy. And past recessions have occurred for many different reasons. A common reason, though, is that there's been an imbalance that's built up in the economy that ultimately needed to be corrected. Okay, so that sometimes happens when an economy grows. Sometimes there's imbalances that happen. But I also want to talk about 2008 for a minute. Obviously, that was definitely a recession, but it was more than that. That was really a breakdown or a failure in our economic system. So obviously, it was referred to as the credit crisis, and there was some huge issues in the mortgage market. So one thing I want to let everyone know is right now there's no apparent systemic issues such as that like there was in 2008. But 2008 was definitely a recession. However, it was more than that. Again, it was a breakdown in kind of how our economy works. All right. So how long do recessions last? And what happens to the markets in a recession? First, let's take a look at the business cycle. So a business cycle starts off first with an expansion. This is a period of increased employment and output. And then the peak happens typically when there's very low unemployment and usually high inflation. And then after the business cycle peaks, there's a period of contraction where this is a decline in total output of the economy, employment, and things like that. And then at the bottom of that is the trough. This is the lowest level of output and employment within a cycle. Um, and then it repeats itself. So we have, again, an expansion, peak, contraction. Trough, again, expansion. So the important thing for everyone to note here is that this is a normal and anticipated business cycle. So obviously we cannot just be experiencing expansion after expansion. This is the normal rhythm of an economy. So this is what we should anticipate. So how long do recessions last? Well, let's start off first by taking a look at how long an expansion lasts on average. So on average, an expansion lasts 67 months. And the S&P 500 return during that period of time is 117%. A recession on average lasts 11 months. And you can see that the S&P 500 only returns 3% during those recessions. And you can see those recessions on this chart going back to about 1950. So recessions are painful, but the takeaway here is expansions have been much more powerful. So another term to discuss is what we call a market correction. So a correction is a term that describes a market decline of 10% or more. So we talked previously that a recession was a term that is an economic definition. A correction is a term that defines a market movement of a 10% or more decline. So you can see here that there's been 6 market corrections since the start of the bull run in 2009. And you can see here, again, more than 10%. There was several here. The fourth quarter in 2018 was really not a good quarter. It was a terrible quarter in the market. But it's also important to note that January and February 2019 was the best 2-month start to the market in the last 28 years. Okay, so you can see here that there's been 9 corrections already since the start of the bull run in 2009. And another steep one was in 2016. There was a 13% correction that occurred early in 2016. So bear markets, so we talked about a correction being a 10% or more decline. A bear market is when there's a 20% or more decline. And bear markets have been relatively short-lived. So you can see here, let's start with the bad news. Bear markets on average last 14 months with a negative 33% total return. But look at the average bull market. A 263% return, and it lasts 71, it averages a 71-month period of time. So thankfully, the bull markets have compensated those that have been patient and invested through the bear markets. Another important takeaway is that market volatility is common and we anticipate it. So there's a 10% or more decline, so you can say a correction, that occurs on average once a year. The average length of recovery is 117 days. You can see a bear market happens much less frequently, so it's about every 6 years. And the average length of recovery is a little over a year. So this, again, is anticipated and is part of the natural economic cycle. So bear markets have been rare outside of a recession. So that's important to note. So you can see here that the median decline during a recession has been 32%, but during an expansion, the median decline has been 21%. And you can see here the average duration, again, during a recession, much longer, 17 months. Again, during an expansion, only a 6-month average duration for that bear market. So again, it's important to note, even when there's steeper declines, this is what a market has done after a 15% decline. So The average 12-month return after that steep market decline has been 55%. So again, the point here is that we do have pullbacks, but the recovery makes it more than worth it. So very important to note. Volatility can also compound investor mistakes. This blue line here is the S&P 500. The shaded blue areas are net asset flows into the market or out of the market. So you can see here, while the S&P 500 declined, people sold. You've probably heard this before. You're not supposed to sell low. You're supposed to buy low and sell high. Conversely, the markets continued to go up and people still sold. So people sold right into about 2014, and then people started to buy. Again, the market dropped, people sold. And since 2017 and 2018, people have been buying into the market. Net buying has, been at a record level. But again, people are buying while the market is going up. So, this is very important to avoid this emotional mistake. What we can see here is that the typical investor buys high and sells low. It's imperative to do the opposite as part of your long-term plan. So why can't we try to time the market? And that's because market timing is extremely dangerous. And when we look at the markets, what we see is that the best days in the market typically occur right after the worst days. So on this slide here, we're taking a look at if somebody invested $10,000 in the S&P 500 for this 10-year period, it would have grown to $18,500. But if they just missed the 5 best days of the market, look at what it does to their principal. They've also missed about 73% of the return. If they miss the 10 best days, they've actually lost money. So it's really important to note that making these sorts of emotional investing mistakes will result in a permanent lifestyle reduction. And what I mean by that is if you miss out on those best days, it's severely going to hurt your return, and then what will happen is that you'll have less principal and you'll have to cut your spending later in life, either when you're retired or if you are retired, you'll have to adjust spending. As I've mentioned to you all before, there's a field of academic field called behavioral finance where they study people's decisions in light of their emotions. And what that research shows is that our brains are typically not wired well for investing. So we all want to go to the restaurant that's very busy because that typically means it's a good restaurant. But with the brain and investing, we typically that fight or flight response kicks in. And again, when we look at the data, people will, when emotions kick in, they'll buy at the market top and they'll sell when prices are low. This is a longer term study that compares investor returns versus the S&P 500. So over the past 30 years, investors have averaged 4%, but the S&P 500 has averaged over 10%. So that is a staggering difference in the amount of potential capital that you'll have for your needs. And whatever time frame you look at, again, it's a staggering difference. So the other thing too is that long-term investors win if they remain disciplined and they invest through multiple economic cycles. So those are the situations where I see where real wealth is created, when you have the discipline to invest through multiple different cycles in the market. So this is showing you 10-year rolling returns in the S&P 500, after periods of decline or muted growth. Again, you can see here typically double-digit returns over that 10-year period. Now, I'm obviously showing you this information because I get that, it's your money and it has to last you the rest of your life. But what I'm trying to do is arm you with information so you can make the most out of your financial resources. So let's talk about how close we might be to the next recession and what economic indicators coincide with a recession. So on this slide here, let's take a look at the likelihood of a recession. So this is based upon the New York Federal Reserve model, looking at the probability of a recession in 12 months. And one thing that is really important to note is that a 30% threshold has been reached before every recession. So that 30% probability has been reached. So far, we haven't reached that probability threshold. Okay? Does that mean for sure that a recession isn't on the horizon? Absolutely not. But again, we have this data and we can look at the probability of a recession according to the New York Fed model. Let's look at some economic indicators that coincide with a recession. So one thing I will tell you, it is impossible to time a recession. And as I've demonstrated, the costs are great of guessing wrong. And there's many different factors that contribute to a recession. So we can't say that these indicators are indicative of a recession forthcoming. It doesn't work that way. There is no algorithm to automatically, determine or with a high degree of reliability that there will be a recession. But let's look at these different indicators. So one is the inverted yield curve. So you've probably heard about the yield curve already. It's been in the news. And this is when 10-year interest rates for a 10-year note is lower than the interest on a 2-year note, okay? So that is inverted. So obviously a 10-year treasury is supposed to pay more than a 2-year treasury because it's a longer duration. The yield curve is at its flattest level since the start of the bull market, but it has not been inverted when you look at the 2 and the 10-year for any period of time. And we'll talk more about that on the next slide. I think that's really important. Corporate profits, if they're declining from the cycle peak, it's important to note that corporate profits have peaked years ago. Unemployment is, if unemployment is rising from the cycle low point. Unemployment currently is near 50-year lows. There are more jobs out there than people looking for jobs. So very important. Housing starts is another indicator. If there's a decline of at least 10% from the previous year, here new housing starts have been flat. And then there's a proprietary index called the Leading Economic Index, which is an aggregation of multiple leading economic indicators. And here, if it's declining, if this indicator is declining at least 1% from the previous year, that could be, again, an indication or a sign. Here, again, this economic indicator is still rising. It started to decelerate, but again, it is still rising. One thing too, before we talk about the yield curve on the next slide, one thing I want to mention about the yield curve is the last time the yield curve inverted, it took 2 additional years for a recession to ensue. So none of these indicators are, it's not a light switch. So timing of a recession, again, is difficult to impossible to tell. So in discussing the yield curve, again, the interest rate on a 2-year treasury is going to be lower than the interest on a 10-year, right? Because obviously a 2-year is shorter in duration, so you should get less interest, right? Because there's less duration risk. Now, one thing I want to mention about the yield curve is that the yield curve is already flatter. And the reason why that is if we take a look at inflation, this is historical inflation since 1900. Inflation used to be much more erratic, and it's been much more tightly managed by the Federal Reserve. And why is that? Because we've learned over the years that high inflation is very detrimental to an economy. It will bring an economy to its knees. So the Fed, they're tasked with keeping inflation. They don't want hyperinflation. They also don't want deflation. So they're trying to keep inflation, right around that 2% level. So if inflation takes off, then that will not be good for the economy. So they've been managing this much more closely since the 80s. And what the Fed does is they adjust interest rates. That is their tool to keep inflation in check. So if we have an economy that's growing too fast and it's overheated, it's overheating, and what they're going to do is they'll raise interest rates, which will then tampen growth a little bit. So I guess what I'm trying to tell you is that before, with the yield curve, there was more cushion between the 10-year and the 2-year. But because inflation is managed much more proactively than it has been in the past, there isn't that much cushion between those two, the 2-year and the 10-year. So very important to note, we have to look at the yield curve slightly different than we have had in the past. All right, so let's discuss a little bit about current economic factors. Again, I mentioned to you previously that there's no apparent systemic issues. Economic growth has been strong. Unemployment has been very low. And so there's no signs of any apparent systemic issues like there was in 2008, 2000. So very important to note. Could there be maybe a bubble that surfaces in the future? Well, of course. But right now, everything looks good. Everything looks okay. So current economic, conditions, I would say are decent. There's no red flags. So that's also, very important to note. I mentioned to you prior that January and February, that 2-month start to 2019 has been the best start to the markets in the last 28 years. Okay. So let's take a look at what we've done to protect against market volatility. So one of those things is, for our clients, we have diversified global portfolios. So our clients own investments not only in the United States, but all over the world, and that's really important. Part of that diversification is owning high-quality bonds. And you can see here, high-quality bonds have shown resilience when the stock markets are are unsettled. And again, we're talking about high-quality bonds that act as this buffer. We're not talking about high yield or junk bonds. We're talking about high-quality bonds. You can see here, when the S&P 500 has had some pretty sharp downturns, bonds have performed well. So 97% of the time, bonds and stocks will move in random or unmatching directions, what we call non-correlated directions. So that is very important. So diversification is really important because the markets are random and unpredictable at times. So if we look at 2000 through the end of 2009, which was a terrible 10-year period for the S&P 500, you would have earned -1% on an annualized basis. But that's if you were patient enough to handle the downturns that happened, after September 11th and after the credit crisis of 08-09. But look at what bonds did. Look at what U.S. bonds did during that period of time. They averaged 6.33%. So bonds nearly doubled in value during that period of time. Now, my guess is that you didn't hear about that in the news or perhaps the nightly news. So that's very important. That you can see here that bonds work, having that diversification work during that period of time. And this darker blue line is, instead of being all US large company stocks, you were 70% US stocks. And that was a mixture of large companies, mid-sized companies, and small-sized companies. And 30% was in international emerging markets. Now you can see here that return for that 10-year period in which the US large cap index did not perform well, this returned 7.44%. So this shows you what the goal is of being globally diversified outside of the United States and being further diversified within the United States. So just because the S&P 500 is down does not mean that all of your positions are down. When the S&P 500 is down, there are positions in your portfolio, at least for our clients, that we're hoping are designed to be hopefully up or perhaps neutral. So asset allocation in our portfolios is also an important step that we take in with the construction of our portfolios and the ongoing management of them. So in this slide, we can look at what asset class performed the best to the worst in any given year. And you can see it's pretty much a checkerboard. So, for example, in 2008, when stocks were doing terrible, bonds did well, 5.2%. You can see here large cap growth was one of the large cap, and international were the two worst. And sure enough, the following year, they were the two best. So again, showing you multiple examples of how sometimes the best days happen right after the worst days. And if you miss those brief periods of time, it will severely reduce your return, and then ultimately how much you can withdraw from your portfolio during retirement. We've also made some very important, I would say small but important, portfolio adjustments in November 2018. So one of the things that we did is we shortened the overall maturity of the bond portfolio by eliminating a longer-term bond fund. We also replaced a shorter-term bond fund with another fund, so that the shorter-term fund that we replaced, that one only invested in short-term corporate funds. And the new short-term fund that we use can invest both in short-term corporate and short-term government bonds. I think that was important because government bonds are more conservative. So in that fund, the manager has the ability to flex or fluctuate between corporate and government bonds based upon conditions in the bond market. Thirdly, as part of the bond portfolio, we added a fund that has a 5% position that invests in dollar-denominated short-term debt instruments. So this particular fund, I guess you can call it a stable value fund. It maintains a value of $1 per share, and it receives interest from the short-term debt instruments that it invests in. So with this particular piece of the bond portfolio, it's obviously more conservative. But here, the way to look at it is, in case that there is some extreme volatility, and let's say that you are retired, so or you're getting closer to retirement, and that concern is on your mind, we typically see withdrawal rates. It depends upon the financial plan, where they'll take out somewhere between 2% of the value of their investments. And some of our clients have plans where they're maybe liquidating more that first 10 years or so of their retirement to be more active. So maybe it's somewhere between a 2 to a 7% withdrawal rate. Again, each plan is different, but we have a 5% position that we could go to and liquidate, where we know that it has maintained a value of $1. So we could sell that position and let everything sit if there was a decline in the market. And we typically free up money for our clients for the next 12 months. And we'll talk about that on the next screen. So that would then give us the opportunity to wait for markets to come back. So number 4 is we fine-tune the proportion of global bonds versus US bonds. So again, that's important to note. You don't just own bonds in the United States. Our clients also own bonds throughout the world. And sometimes when US bonds are down, global bonds might be doing better. So within our portfolios, we have about 14 different asset classes. So if you can think about it, we have 14 different buckets to go through for distributions, or if somebody is saving for retirement, to buy into that are lower. So, and I guess the fifth thing I want to mention is that with these changes, one thing we did not change is we did not change our equity, or you can say our allocations to stock. So that is important that we maintain that stock exposure because we know that that's important for the long term as a hedge for inflation or other potential expenses that someone might have in their life. So prior to these changes, we also made previous changes which basically allowed for more strategic management of bond holdings. So the institutional managers that we use, they have the ability to monitor the bond market and look at the conditions of the bond market and then make adjustments. So we think that's really important. That's something that they do on an ongoing daily basis. So for example, one thing that they do is they'll monitor the price in which bonds are selling for. And if they notice that a bond is selling at a price that's more indicative of a junk bond or what's called a high yield bond, they have a proprietary system in place to identify those situations and then make determinations whether they should sell that bond. Because there's always a delay between how a bond trades and when the credit rating agencies change their credit rating from investment grade down to junk bond status. So that's just another example of what's happening behind the scenes to manage risk. So we talked about in this previous slide how we manage distributions for our clients in retirement. And we're going to tie that into threshold-based rebalancing. So let's talk a little bit about each of those. So as far as threshold-based rebalancing, one of the things that we do for our clients is that at least quarterly, we check to see if any positions are out of band. So what we're looking for is for positions that have grown past band, and we're looking for a sizable movement. And our software is very sophisticated. So if it knows that a position has grown out of band, we'll get alert that it's out of band, and then it would make sense to sell. In that scenario, you're selling higher, you're selling it, and you're bringing it back down to the target allocation. Conversely, if a particular asset class is dropping in value and it's dripped below a certain band level, we want to be able to recognize that as a buying opportunity. So threshold-based rebalancing is really important. And it's important to note that that first week in January, which was right about here on the chart, we rebalanced our client accounts to take advantage of the volatility. Because again, the fourth quarter, especially December, was awful. There was a sharp decline. And we rebalanced that first week of January. I wanted to rebalance right after Christmas, but there's the trading volume in the markets the week after Christmas is much lower than normal, and that is not a good thing for trying to get the best share price. So we waited till kind of Wall Street, if you will, was back at their trading desk that first week of January. And when we did that, it sold positions off and it bought positions that had declined in value. And again, it's only doing it if it crosses the band. And then we're recording this on March 28th, but a couple of days ago, we rebalanced again. And you can see here, this pink line is real estate. So real estate has climbed dramatically since the beginning of the year. So for accounts that were affected, it was typically selling the real estate position. So that threshold-based rebalancing is very important when somebody is saving to retirement. It's also very important when somebody is retired and dollar cost averaging out of their portfolio, meaning that you're taking a little bit money out of your portfolio every month. You're not going to take you're not going to take a lot out a month. You're going to take a certain amount of money out every month. So you didn't put it in the market all on one day, and you're not going to take it out of the market all on one day. So when we free up distributions for our clients, we're very strategic about that. So when we free up distributions, money for distributions for our clients, we're typically freeing up that money for the next 12 months. And we're being very strategic about what positions to sell. So if we were doing this as of this slide is as of March 22nd, we would sell positions that were up the most first, and then avoid selling anything that was down. So that is the goal. And again, the portfolios are so fine-tuned, and we know this is by design that these lines are not one on top of one another, because again, these different asset classes tend to move in different directions, meaning that they're non-correlated to an extent. So they're not perfectly going to move in the same direction, which is what we want. We want there to be, while some positions are up, some are neutral, and some are down. So again, the whole goal of this is to sell high, even when we're freeing up cash for distributions. And as you can see here, bonds, this is over the past year, have grown a little bit. Some of them have grown a tiny amount. So we have different options. So our portfolios are so diversified. The way that I like to view it is that we're trying to, as best as we can, make the portfolios all level. So we want to make sure that there's sunscreen in the portfolio, an umbrella, boots, gloves. So you kind of get the analogy. But again, there's no guarantee, but over time, diversifying and being disciplined and withdrawing money in a very disciplined manner has worked. And obviously you're counting on us to do this with relentless discipline. All right, so another thing that we've done to help our clients with the possibility of a downturn, whether it be a 10% correction or whatever it might be, is for our clients that engage us for financial planning services, is obviously to provide them comprehensive financial planning. And a part of that is to provide them a financial plan that identifies their goals, such as when they want to retire, how much they want to spend, an anticipated life expectancy, and then a list of all their resources, whether it be pensions or Social Security, investment assets, whatever resources that they have. And then what the software does is it stress tests the plan. And it runs 1,000 trials, 1,000 different return possibilities, which includes some bad market conditions. So it's stress testing the plan across what we call a normal probability of possible outcomes. And so that is applying a lot of stress to the plan. So in this particular scenario, this particular plan has a probability of success of 99%. So this particular plan is very solid. It has the highest probability of success the software will issue. And so knowing what your probability of success is very important, and understanding what is behind that. So in this particular case, you can see with our financial plans, we like to see our financial plans for our clients have a probability of success of at least 85% or greater. And here's the description of being in the confident zone. It's a good balance between current and future lifestyle, and it may hold up well against future shocks. The previous plan I showed you was in the above confidence zone, which is okay if you're ultra conservative. So what we do with our clients is we educate you on what that probability of success means and what percentage are you comfortable with when you sleep well with at night. And also monitor that probability of success on an ongoing basis, right? The software knows what tax rates are, it knows what historical inflation is, it knows what historical returns have been, and it's stress testing it by looking at 1,000 trial simulations. But we know that sometimes returns are better or worse than we expect, and inflation is higher or lower than we anticipate. And sometimes in life, life will unfold. So, you might have more grandchildren than you anticipate, or perhaps have other hobbies. So, life unfolds and economic conditions unfold. And what we do Our goal is to help our clients proactively manage that probability of success and even define what we call a floor probability of success, where if the plan dips below a certain percentage, we know that's when adjustments are warranted, perhaps an adjustment in spending or other things. Okay, so let's discuss what you need to do to maximize your financial success. So number one, tune out the media. Be very careful of your news and information sources and ignore the short-term noise of the market. Very important. So we've obviously made a proactive, predetermined decision on how we're going to manage the money, manage investments, and how we're going to react to things when both the markets are declining, which is we want to take advantage of that and then help our financial planning clients see if they need to make adjustments. And conversely, if markets are on the rise, we also want to take advantage of that and sell positions that have grown out of band. So number two is to increase your financial knowledge. And understand that investing is not easy. It really isn't. Even with all these things that we've done to manage risk, and because we can't control the markets, which is why we have to do all these different things to manage risk. But I can share with you, I've been in personal finance for almost 20 years now. And I can share with you that when somebody increases their financial knowledge and they have a certain level of understanding, those people are typically a lot more peaceful about their finances. They typically have greater peace of mind. So if you feel like you need to increase your financial knowledge, I hope that this presentation helps, and we're also available to be a resource for you. If you're retired, the most important thing to do is to monitor your spending. As a certified financial planner, I have to do yearly continuing education. And I remember, I think it was a year or two ago, reading about a study about why people filed bankruptcy in retirement. The number one reason people filed bankruptcy in retirement was their spending was excessive compared to their level of resources. So the number one thing to do here, if you're retired, the number one thing you can do to maximize your financial success is to make sure that you're spending within what you put in your financial plan. So for that probability of success to mean anything, you have to spend according to that. If you're spending above that, that's obviously detrimental. So the second biggest factor of why people filed bankruptcy was accruing credit card debt and the cascading debt that followed. Okay, so I feel like we have some wonderful, great clients who definitely have increased their financial knowledge with us, working over the years, and do a really good job of having fun in retirement and making sure that they're spending within what they wanted to plan for. So if you're not retired, my biggest advice to you is to continue to invest into your retirement plan at work or whatever account you're investing in, especially during buying opportunities or when the market is having a bad stretch. Why is that? Because you're buying in at cheaper prices. So you're dollar cost averaging in. So you're going to dollar cost average in until retirement, and then you're going to dollar cost average out once you retire. So again, before you retire, you want to make sure that you take advantage of those opportunities. And if you do anything during a period of a market decline, you want to increase your contributions if at all possible. Number 5 is you want to maximize your decisions and focus on what you can control. So no one can control the market, which is why we have to do a myriad of things to manage risk. And obviously, real investing is defined as not taking any more risk that's needed to achieve the rate of return that you're going for, okay? But we have to do all these things to manage risk in the market because we can't control the market. No one can, and no one can reliably tell what the market's going to do and when, okay? But what you can control is your financial planning decisions to enhance your wealth. And that is obviously a major focus of what we do with our clients, whether it's tax planning or looking at strategic Roth conversions or looking at estate planning, looking at other risk protection planning to make sure that you don't have any unnecessary or unwanted risk. So there's so many different types of activities that we work on with our clients to enhance wealth. One of those during a market decline is actually taking a closer look at Roth conversions. Now, why is that? Because you're converting shares. So if you can convert 100 shares at a lower value into a Roth, right, you're going to pay less income tax, but you're still converting the same amount of shares. So again, there's always a bright side to things. There's always a way, I believe, to maximize your decisions and enhance your wealth. So number 6 is that with our expertise and assistance, we can always revisit your financial plan. So right now, the markets are showing some wherewithal. But if they don't, if there is a correction at some point in the future, there's going to be a 10% correction again. But it might be a time to revisit your plan and look at what is your probability of success. Do you need to make any spending adjustments? Maybe you don't. It all depends upon your circumstances. So I've met with people, they have different financial circumstances, different goals, and after corrections, I've told some people, listen, you don't need to make any adjustments. And others, I said, yes, you should consider making this adjustment. So again, we can always revisit your plan. If you're working, could you possibly increase savings or make any other plan adjustments? Again, if there's any ensuing volatility, or I guess the question is not if, but when, again, in that scenario, if you're still working, what can you do to make that advantageous? And number 7, and lastly, for our financial planning clients that we've worked with together, especially those that we've worked together with, over at least 2 or 3 years, where we've had some time to really build that financial plan together, stick to your financial plan. And even if you're a new client, stick to the plan. Call us first to see if you should make any adjustments. We're here to help, and we understand investing is not easy. And although we have all these different things in place to manage that risk, it still doesn't make it like going on vacation. All right, so in this chart here, we're looking at investment growth. And my message here is to maintain a long-term perspective. So in this particular case, this growth chart is from March of 2011 through March of 2019. And this particular client has a longer term perspective on volatility with us. So you can see that sharp drop in 2016. And back then, when their time horizon was narrower, that was a much bigger dip, but things have happened, have grown, and then now we have that fourth quarter dip and then the return. So I guess what I'm trying to tell you is that you want to keep the long-term perspective in mind. You don't want to pick arbitrary dates to compare returns. So I was talking to somebody and they were like, well, yeah, I looked at my, return here at the peak and I compared it to my return that particular date on the bottom, and I compared those monthly statements and it was down X amount of dollars. And I said, well, you're picking a date where your values were the highest, and you're picking a date when your values were the lowest. Like, that is not beneficial to anyone financially or emotionally or for your health. So you can't just pick arbitrary dates. I one time said in a different video that you not only need to be aware of what your return has been since you've been working with us, but what has been your lifetime return? And I actually had a client that said, Tony, I've actually tracked my returns ever since I started investing in a retirement plan. And this person is in their 60s, so he completely got that. So you can't just focus on what your return has been over the past year, 2 years, 3 years. what would have been your return if you were in all cash for the past 20 years versus a diversified portfolio? You have to look at the long-term trends and understand the decisions that you're making are setting you up to have the highest probability of success for the long-term future. So very important. The other thing too I want to share with you is to be aware of financial advice or commentary that you get from your friends over cocktails, perhaps. There's actually a study out there. I didn't have time to locate that again, but they studied financial advice and investment decisions that were implemented from friends from cocktail parties. And the results were horrendous. Your friends do not know your financial situation, nor is it probably a good idea that they do know that. And their level of education might be completely different than yours. So I think that's also very important, is to, again, be very careful of where you're getting your information. So again, the takeaway here is to maintain that long-term perspective. All right, so in conclusion, are we headed for a recession, soft landing, or continued growth? To be honest with you and transparent, I have no idea. It's impossible to predict when a recession will incur. We perhaps might have a soft landing. Maybe we'll have muted growth. Maybe we'll have continued growth. It's really hard to tell. But as you can see, we looked at many different data points. We know that the recoveries after a decline, those recoveries have made investing through the decline worth it. And again, investing even through short-term volatility, I believe, is where real wealth is made. Obviously, if I had that ability to determine when a recession would occur, boy, like I could start off with a very small portfolio for myself, in about 5 years, become financially independent, and nobody has that crystal ball, which is why that we do all the things that we do to manage risk, have a comprehensive financial plan that's stress tested, and do that ongoing manager due diligence, threshold-based rebalancing. So those are very, very important. And, I've shared this with our clients before, but I invest in the same exact funds that we use for us. And we even have a retirement plan here for our employees. We think that's important for our team, and to have team members that are here for the long term. And we use the same investments in that retirement plan that we do for our clients. So in a nutshell, there's no way to tell for sure what's going to happen and when it's going to happen, but we have to have a plan, and we do have to manage things and keep our eyes on. So I hope you found this presentation very helpful. If you're a client of ours and you have questions, we'd be more than happy to hear from you. If you're not a client of ours and you perhaps want a second opinion, we'd be more than happy to meet you, learn about your situation and your goals, and see if there's any gaps in how you're positioned. So with that, again, thank you very much for joining us for this video, and thanks for watching. Have a great day.